Let's have an overview about the whole situation. So the whole thing here is that if your business owes money to the IRS, one method of resolving the tax balance due is to request a payment plan. And the thing here is that this is the method that the IRS favors the most. Well, second to paying in full immediately. So the thing here is that if your business owes cash, do not ghost the agency. See, the whole thing is that if you ghost them, this is really the worst option possible. So an IRS monthly payment is called an installment agreement. And this basically means that your business pays a certain amount of money each month to put towards its tax liability. While you are making these payments, interest will continue to accrue, as will late payment penalties. But the good thing is that at least you have started a conversation with the IRS. This is really good. This is actually great because they're not going to pursue any sort of criminal penalties or whatever trying to sue you. And the IRS will also keep any income tax refunds that are due to the business until the liability is paid in full. So basically, we're speaking here about what? A C corporation, because S corporation, LLCs, and other partnership types of corporations, they pay taxes at the individual level. So you don't actually have to pay taxes at the business level, because you only when you are filing a 1065 or 1120S, for example, those are called informational returns. So you don't pay taxes on those returns. So there are no refunds expected on those returns. Okay, and so the thing that's very important to understand is that if the business is still operating, the IRS will allow an in-business installment agreement if the business is able to keep up with its current expenses, current taxes, and can make payments towards its past due taxes. If the business cannot afford to pay anything towards its back taxes because it requires all available resources to pay towards its current expenses and current taxes, the IRS may take enforced collection and essentially force the business to close down. Sometimes it's best to reduce current expenses or the items giving rise to the current tax expenses, such as reducing payroll, in order to avoid such catastrophic results, really. Now, there are different types of business installment agreements with the IRS, but some requirements are true for all of them. So you must have filed all required tax returns for the business, and you must be current on all required tax deposits for the current tax period and often for multiple past tax periods. So this is important. Now, the available types of installment agreements are in-business trust fund installment agreement, streamlined installment agreement, and installment agreement. Let's just talk about in-business trust fund express agreement, basically the installment agreement. So it's called the IBTF Express IA, in-business trust fund express installment agreement. So this is actually the first option that you have if you owe the IRS money and you are trying to pay your back taxes, whatever liabilities that are currently outstanding. So an in-business trust fund express installment agreement, this is a mouthful here, is available to small businesses that owe back payroll taxes. So we are speaking about IRS Form 940, 941, or 943. And so this is available to small businesses that owe back payroll taxes and still have employees. So the conditions is very clear. The amount of payroll taxes owed must be $25,000 or less. If the business owes more than $25K, the business will need to consider a different type of payment plan. So the whole thing here is that there are several payment plans that are adequate for a specific situation. So the business must agree to monthly payments that are sufficient to pay the liability in full within 24 months or prior to the expiration of the time the IRS has to collect the debt. This is referred to as the CSED, meaning collection statute expiration date. So the IRS has a statute of limitation that within which it must collect its taxes. So, they have some kind of obligation to collect taxes from you during that time. So it's very important. So 24 months or prior to the CSED, very important. Now, if the business owes between $10,000 and $25,000, it also must agree to make these payments through debits directly from its bank account. So that's called a direct debit installment agreement, or DDIA for short. So the thing is, there are some conditions that you really have to follow. Typically, if a business qualifies for this type of payment plan, it will not have to provide any financial information to get the IRS to approve the payment plan. So the IBTF Express IA is relatively the simplest form of agreement, because again, you don't have to show any sort of paperwork. You don't have to substantiate your financial situation, your business financial situation. Not at all. The IRS will take your word for it. And the only thing is, you need to pay within 24 months, and it has to be money has to come from your bank account, your business bank account, through direct debits. Let's talk about the second option here. That's called a streamlined installment agreement. By the way, I want to quickly just remind everybody of today's topic. We are having a conversation about IRS installment agreement for business. Okay, so we definitely have 3 different installment agreements for business. So the first one is the IBTF Express IA. I just spoke about that. The second option is the streamlined installment agreement. So businesses can also qualify for a streamlined installment agreement, similar to individual streamlined agreement. The individual streamlined installment agreement in certain circumstances. So the whole thing here is that the business must agree to payments that will fully pay the liability over 6 years or prior to the expiration of the CSED. So instead of 2 years, as we had in the IBTF Express IA, for the streamlined installment agreement, the period is 6 years maximum. Okay, if your business is still open, it can only qualify for a streamlined installment agreement if it owes Form 1120, income taxes or penalties. That's what I just said, right? Because basically, you need to actually file Form 1120, the corporation type of return. So it can qualify for that agreement if it owes Form 1120, taxes or penalties, or Form 1120S, late filing penalties or income taxes, or Form 1065, late filing penalties. So this is really important. Okay, and one thing I want to say here is that the business must owe less than $25,000. Now, if your business is closed and still needs to enter into a payment plan, it can qualify for a business streamlined installment agreement if it owes any types of business taxes and owes less than $25K. So $25K is really the threshold when we speak about this types of agreement. So the IRS will not typically require a collection information statement. This is Form 433B if the business qualifies for and requests a business streamlined installment agreement. If the business qualifies, typically the IRS will not file a tax lien, but it does have the power to do so. So the IRS always has the flexibility to do so. So this is what they do, is they do this on a case-by-case basis. This is why we always say you want to contact the IRS. Never ghost them. If you're having a situation, if you have a problem, if you can't pay your taxes, your business taxes, always contact the agency and start a conversation. Let me talk to you now about the installment agreement, the third option when we talk about IRS installment agreements for businesses. So just want to quickly remind you guys. So the first option is the IBTF Express IA. Second option is the streamlined installment agreement. And the third option is just a simple installment agreement. So if your business has tax debts of over $25,000, cannot afford a streamlined installment agreement, or does not qualify for a streamlined installment agreement, the IRS can still approve a monthly plan for the business. There are always options here. This is why I'm just telling you, you need to start a conversation with the agency. And this is one thing. Now, however, the IRS will require a full financial analysis of the business, including a collection information statement, Form 433B, and all required supporting documents before it will consider accepting a monthly payment plan proposal. So basically, the scrutiny on this at this level is higher. In other words, the IRS wants to really have a clear idea about the company's finances before deciding whether or not it will approve you for an installment agreement. Okay, and so if the business owes payroll taxes, I'm talking about IRS Form 940, 941, or Form 943, or excise taxes, IRS Form 720, 2290, or Form 730, or any other tax that is treated as being paid to the business and then paid from the business to the IRS will need to assign a revenue officer to consider the business payment plan proposal. Okay, but one thing I need to really specify here is that before entering into any payment plan, the revenue officer will need to determine whether it should assess some or all of the trust fund taxes to any of the business owners or managers. So basically what we're talking about here is that the IRS can move beyond the business structure and actually quote unquote attack the individual owners for I mean they can actually just seize their properties, or they just place a lien on their personal properties in order to recoup the money that is due to the government. So they do have that power. So based on the financial analysis that the revenue officer does, you can often reach a monthly payment plan that the IRS believes you can afford. If you cannot afford this amount, you may need to reconsider whether your business qualifies for an offer in compromise instead. Now let's talk about a business payment plan. This is really important. I just want to quickly remind our beloved viewers of today's conversation. We're talking about IRS installment agreements for a business. So the big question here is that, do you qualify? Does your business qualify for a payment plan? So the thing here is that the IRS will look at a constellation of factors to determine whether or not your business qualifies for a payment plan. Your specific tax situation will determine which payment plan options are available to you. Payment options include full payment or a long-term payment plan. So this installment agreement, meaning you're paying monthly. So you may qualify to apply online if a long-term payment plan is, let's say you have filed all required returns and you owe $25,000 or less in combined tax, penalties, and interest. So this is really important. Now, if you are a sole proprietor or independent contractor, you want to apply for a payment plan as an individual. Why? Because you have filed a Form 1040. The same applies if you are a single member LLC. So setup fees may be higher if you apply for a payment plan by phone, mail, or in person. So the IRS wants you to do everything online. It's faster for them. It is cheaper for them too. So what does your business need to apply? So to apply as a business, you need to log in with your IRS username or ID.me credentials. Okay, so they have a website for it. If you have any question, please let us know. We'll certainly link you to that page. It's very simple. They will set you up, and then you can track things from there. Now you will also need your employer identification number, the date the business was established, the month and the year, your caller ID from notice. Okay, if you recently filed your tax return or your return was examined but have not received the balance notice from the IRS, you also need a business address from the most recently filed tax return, the balance due amount, tax form filed or examined, the tax period filed or examined. So the IRS just want to have a constellation of let's say of documents to know exactly whom they are talking to, what kind of business they are talking to, or they're talking about. Okay, so please be sure and be very thorough here, because they really take that paperwork seriously. Let's talk about the cost, because obviously you want to set up a payment plan. This is kind of cool, okay, but how much does it cost? Well, if the IRS approves your payment plan, one of the following fees will be added to your tax bill. So you will have the outstanding tax bill, the outstanding tax amount that you owe, and then you have on top of that you have additional fees. Okay, so let's talk about the plan options and cost. So the pay now, so they have the pay now option. So $0 setup fee, no future penalties or interest added. So basically, you can pay the amount owed in full today, electronically, online, or by phone using EFTPS, electronic federal tax payment system, or by check, money order, or debit or credit card. So if you pay now, there are no fees. Now, there are fees may apply when paying by card. Okay, So that's option number one. Then you have option number two, long-term payment plan. So you have the installment agreement. So you are paying monthly. So if you pay monthly through automatic withdrawals, there is a $31 setup fee plus accrued penalties and interest until the balance is paid in full. So you pay at the amount owed through direct debit with automatic payments from your checking account, your business checking accounts, also known as direct debit installment agreement, DDIA. So this is required if your balance is more than $10,000. And so this is option number two. Now, if you pay each month non-direct debit, there is a $130 setup fee plus accrued penalties and interest until the balance is paid in full. And so after applying for a payment plan, you want to pay the amount owed through non-direct debit, non-automated monthly payments, including paying electronically online or by phone using the EFTPS or by check, money order, or debit or credit card. Just want to quickly remind you that EFTPS means electronic federal tax payment system. There is a website for it. We can certainly direct you. If you can't find it, let us know in the comment section. Okay, now fees always apply when paying by card. I just want you to really understand that. You can also revise an existing payment plan, installment agreement, or reinstate after default. So if you want to do that, if you find yourself in that situation, there is a $10 fee to kind of do that. So this kind of gives you an idea of how much it costs. Let's talk about the procedures that you need to follow if you want to review or revise an existing plan. And because things happen, maybe you started a plan with the IRS and stuff happens and your business is doing better or worse financially speaking, and you want to revise or review the plan that you currently are on with the IRS. So let's talk about reviewing a payment plan. So everything happens online though, just very important. I just want to mention that. So you can view details of your current payment plan, type of agreement, due dates, and amount you need to pay by logging into the online payment agreement tool using if you go to the IRS website, you'll see everything there. Okay. And again, if you need help, we'll certainly we can send you that link. So you can use the online payment agreement tool to make the following changes. You can change your monthly payment amount. You can change your monthly payment due date. You can convert an existing agreement to a direct debit agreement. You can change the bank routing and account number on a direct debit agreement. You can reinstate after default. So you have a constellation of options if you go to that part of the website. So this is really important. And so one thing I want to say here is that, and it's very fast and very easy. Okay. Now, how do you revise an online payment plan? Well, you need to log into the online payment agreement tool using the apply revise button on the IRS website. And what will happen here is that on the first page, you can revise your current payment plan, payment date, and amount. Then you just need to submit your changes. If your new monthly payment amount does not meet the requirements, you will be prompted to revise the payment amount. And if you are unable to make the minimum required payment amount, you will receive directions for completing a Form 433B. Okay, I just spoke about that. So that's basically, and directions will also let you know how to submit that form. So Form 433B is collection information statement for businesses. So to convert your current agreement to a direct debit agreement or to make changes to the bank account associated with your existing direct debit agreement, you want to enter your bank routing and account number. If your plan has lapsed through default and has been reinstated, you may incur a reinstatement fee. Okay, so you also have a power of attorney for a business. So to apply as a power of attorney for a business, you need to log in with your IRS username or ID credentials, and you also need taxpayer identification number, your CAF number, your centralized authorization file number, your caller ID from the taxpayer's notice or POA's signature on signature date on Form 2848. If the taxpayer's return was recently filed or examined, you may also need business address of most recently filed tax return on file, the tax form filed or examined, the tax period filed or examined, and the balance due amount. Thank you so much for your attention. I really appreciate it. I just want to quickly recap to this conversation. So we were talking about IRS installment agreements for businesses. So I gave you an overview about the whole program. We spoke about IBTF Express IA, streamlined installment agreements, and a business payment plan. How do you qualify? What does your business need to qualify? How much does it cost? How do you review or revise an existing plan? And we spoke about power of attorney for a business. Thank you so much. I really appreciate it. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.